What's up, everybody? My name is Joe Brownie, and this is Heresy Financial. Friday saw the release of the July jobs numbers, and despite expectations being pretty much all over the map, the July jobs numbers actually beat expectations. As a result, we saw a couple things take place in financial markets. We saw Bitcoin and stocks rise substantially, and we also saw a sell-off happen in gold and bonds. So in this video, we're going to talk about why the July jobs report is causing bonds to pop, yields to drop. That's not right. Bonds are dropping, yields are popping. Ready? Let's dive in. So the economy added about 943,000 jobs in July, in contrast to expectations of around 850,000. Similarly, the unemployment rate fell to 5.4% versus the expectation of 5.7%. So why would this have an impact on the bond markets that causes bonds to sell off? Well, it all comes down to expectations about the Federal Reserve's response. And we know that for a long time now, the Federal Reserve has been very clear that they're ignoring any inflation numbers because they're seeking maximum employment. They've said continuously they're looking for substantial further progress in the jobs market before they do anything, regardless of what inflation numbers do. So now that we got some substantial jobs numbers coming out, the market is starting to get fearful of what the Federal Reserve might do in pulling back some of its easy monetary policy. Basically, the better the economy gets, the more the market starts to price in a taper. So what is tapering? This is where it's vital to pay attention to the language very closely, because we all know the Federal Reserve loves to use language that everybody perceives one way and when they actually mean another thing. Because really, when they're talking about tapering, you could be interpreting it one of two ways. Either they're talking about tapering their purchases, or they're talking about tapering their balance sheet. Because last time the Federal Reserve tapered started in 2018. That was a balance sheet taper. If you look at this chart of the Federal Reserve's balance sheet, they actively started selling assets in 2018, and their balance sheet was being reduced in size, getting to the point where it caused a liquidity crunch, which was in September of 2019, and we all know what happened in September 2019. We like to call that the repo market blew up. This is because when the Federal Reserve is buying bonds out of the market, they're inserting cash into the market, money into the market, because you have to pay for what you're buying, right? And so the opposite happens when they're selling assets. When they're selling assets like bonds off their balance sheet into the market, they're withdrawing cash from the system. Well, this got to the point where in 2019, there just simply wasn't enough cash in the system. There was a liquidity crunch that led to the repo market blowing up. But what the Federal Reserve is talking about, and what the market is starting to try and price in, is not a balance sheet taper. What the market is pricing in is simply a purchase taper. Because right now, every single month, the Federal Reserve buys at least $120 billion worth of assets that they add onto their balance sheet. About $80 billion of this is going to be treasuries, and about $40 billion of this is going to be mortgage-backed securities. And so when you hear the Federal Reserve talk about potentially starting to taper soon, what they're talking about is tapering their purchases. Maybe move from $120 billion a month to $100 billion a month, or $80 billion a month, or $60 billion a month, or whatever it is. All that they're talking about is reducing the size of their monthly purchases. They would still be growing their balance sheet, just growing it at a slower pace than they are right now. And then the next step after that would be looking to continue to taper until their asset purchases stop completely and their balance sheet just stays steady and stops growing. Only at that point could you start talking about a balance sheet taper, where you actively start selling what's on your balance sheet and reducing the size of that balance sheet. So we've got a long way to go before we get there, and what the market is currently starting to try and price in is just a purchase taper. It's where they would move from $120 billion a month to purchasing a little bit less than that per month. Because if the market expects something to happen in the future, it's going to get front run. That's what markets do. They bring future expectations into the present prices. Just like if you expect a new iPhone's going to come out next month, and you go to sell your iPhone and everybody else is selling their iPhone too, those used iPhones are going to be down in price, even though the new iPhone hasn't come out yet. The market is a forward-looking machine. It prices in those future expectations to today. But here's the truth. The Federal Reserve cannot taper. It's just not going to happen. They can talk about it, and they can talk about it some more, and they may even, after months and months and months of talking about it more and more and attempting monetary policy via statements and expectations, they may even try tapering just a little. But the truth is the bond market cannot survive without the Federal Reserve. That was true when they tried to taper their balance sheet in 2018 and 2019, and it's even more true today after the Federal Reserve has swallowed so much toxic financial garbage compared to where it was 2 years ago. The fact of the matter is the Federal Reserve is buying bonds right now so that the bond market doesn't collapse. And if bond prices plummet, that means yields spike. Remember, if I borrow $100 from you at a 1% interest rate, that means when the bond matures, I owe you $101. You can sell that debt to somebody. So if bond prices go up, you can sell that debt to somebody else for $101. When that debt matures, now I owe my money to that person now. And how much do I owe them? How much do they get? $101. Same amount. But how much did they pay for that debt? $101. So what's their interest rate? 0. Their yield is 0. Now what happens if instead bond prices went down and you sell that debt to somebody else for $99? How much does that person get when my bond matures? Well, they still get $101. So what's their interest rate? 2%, because they bought it for $99 and they get $101. So bond prices are directly inversely correlated to bond yields. And US households, corporate America, and governments are too over-leveraged. In fact, we're so over-leveraged that this debt isn't paid off and nobody expects this debt to be paid off. The expectations is that this debt will be serviced and rolled over in perpetuity. And if interest rates on debt go up, you can no longer afford to roll over that old debt. If you're maxed out and you can only afford to service the debt payments that you have right now, plus your expenses, and you have to get a new loan to pay off that old loan, that's what rolling over that debt means, but that new loan has a higher interest rate, you're insolvent. You can no longer afford to pay your bills. You can no longer afford to service your debt. You certainly can't pay it all off. This would cause a collapse in the debt markets, which means default. And if companies default, equity markets collapse. If households default, real estate markets collapse. If governments default, the global financial system collapses. The entire thing, the whole enchilada, it all rests on the bond markets. So the Fed cannot afford to trigger another taper tantrum. And if the markets give any indication whatsoever that they cannot support bond prices without the help of the money printer, the Federal Reserve must step back in. They have no other choice. Well, okay, so that's not entirely true. They actually do have a choice. They could let everything just collapse. But read your history books. Politicians and bureaucrats never choose the more painful option now, even if it's a healthier option long term. They always choose the easier option now. Future shitstorms be damned. So as we see markets right now pricing in the increased likelihood of the Federal Reserve potentially tapering their purchases and then maybe even their balance sheet later on, what we might actually be seeing is the markets trying to force the Fed's hand. Keep supporting us, keep dealing to us, keep juicing us with easy money, or we let go and everything falls apart. In light of those two choices, risk collapse or keep that printer turned on full speed, which do you think they're going to choose? As always, I really appreciate you guys. Thank you so much for watching. Have a great day.